I feel like the way the market is now, you can both buy and or sell. I try to stay positive all the time. It's not easy to do sometimes, but in good markets, we make money. In bad markets, we make money. So it's just getting yourself in a position where you don't blow yourself up and being in a position to be able to act when the opportunity comes. And I think we're kind of in that cycle.
Welcome to the Deal Flow podcast. Today, we're delighted to have Jay Biggins, founder and owner-operator of Multifamily.com with us. Jay brings over 2 decades of experience in multifamily property management, having successfully managed and transacted more than 150 affordable housing properties across the southeastern United States. Jay, thank you so much for joining us today.
Thanks for having me.
Yeah, well, thank you. Appreciate it. So you have quite the storied career. If you wouldn't mind, could you just do it in your own words? Just give me a little bit brief background, few minutes on your career and kind of what you're focused on today.
I really started about 20 years ago, and I started buying, just small properties, duplexes and quads, and then quickly went up to 10 and 12 units. And I started actually condo converting small properties in Florida and selling off individual units after major upfitting. And then as the market kind of crashed, I decided to actually try to buy apartment buildings for the rental income. But what I realized along the way was I could treat it just like I did the condo conversions. Instead of selling off individual units, we come in, fix problems, and sell off the apartment complex as a cash flowing asset. So kind of quickly evolved into that. And then over time, as markets change, we've shifted how we've done things. But yeah, that's basically where the start came from. And, historically we had done, at that point in time, I was doing, 1 property a year until maybe 2010. And I made my first really big gain. And then I started doing multiple properties at a time. And now at any given time, we're buying, selling 20 plus communities.
Wow. Okay. Yeah. So that's a small start as usual, but then it kind of hockey sticks up as time goes on. Would you say? Maybe could you tell me a little bit about you said that you kind of started in the condo space, doing individual condos, and then you started doing value add properties. But it sounds like your career and the velocity of transactions really started in 2010. Which was a great time to kind of start, increasing your velocity, right? Post financial crisis. Tell me a little bit about that time in the early 2010s on what allowed you to really increase your velocity around that time.
It was really just capital. By 2010, I had several years experience, but just not enough cash flows. I've never raised money. I'm not a syndicator. I wouldn't even, have first clue how to go out and start raising capital. So I had made a big enough gain where I could actually do multiple investments at the same time. So that was really the catalyst that launched and, grew at a faster pace. But I will say one of the questions I get most often is, how do you find your properties? And I think it's a lot less about how we find properties and a lot more about how we look at what we're sizing up for an investment. And typically when I start, if a broker calls me, and I get calls every single day on particular properties and, hey, would you have an interest in this? And I have the same line of questioning over and over and over. And I try to do a shortened underwrite in my head in the first 3 to 5 minutes and know if, I really have any interest in moving forward on that deal. And then if I get past that initial test, my underwrite from there really doesn't go all that much further. I still, kind of joke that I underwrite on the back of a napkin, and I actually do. The first few questions I like to know is, I want to know, what is the price per unit? I want to know what the average in-place rents are. And then I want to know what the vintage is. And I would like to know the location. And they're all tied together for different reasons. So with a quick snapshot of average in-place rent versus price per unit, I can do a quick gross rent multiplier in my head to see if I'm just going to eliminate it, which 90% of the time I do right then and there. And then if that kind of feels like, okay, warrants a little bit more investigation, I'll want to know the vintage, not only because it might tell me something a little bit about the asset class, because if it's 2015, maybe it's a B or better. And if it's 1970s, maybe it's a B minus or a C. But it's not just that. It tells me a little bit about my OpEx, my operating expense. So I know if I have an older asset, my repairs and maintenance are going to be higher. And if I have a newer asset, my R&M is going to be much lower. So I'll marry that information with location. And when I'm talking about location, I'm not just thinking of it from a comparable sake. Like, for example, you might have properties in Charlotte that trade at a minimum of $120,000 per unit, whereas something 45 minutes outside of Charlotte might trade closer to 100 or 80 or whatever it may be. So there's the comparable approach mindset, but also as it relates to OpEx again. In Charlotte, just as an example, we could use almost any city and talk about it, but in Charlotte, the average OpEx might be around $7,000 per unit per year. Whereas 45 minutes outside of Charlotte, it might run $4,000 per unit per year or $4,500 per unit per year. So if you're talking about 100 units, your OpEx in Charlotte is going to be around $200,000 to $300,000 more than it would be just outside of that market. So when I'm doing a quick snapshot of my price per unit, my average in-place rents, what's the location, and what's the vintage, those are all the things I'm thinking of. It's not just about, oh, it's in Charlotte. It's about, okay, what does that mean to me in terms of OpEx and how I have to adjust my gross rent multiplier model in my head to allow for a wider margin or a narrower margin based on where that property may be. So I try to shortcut it so I have a quick 5 or 10 minute understanding of whether I want to move forward on this or not.
Sure. Yeah, no, that's a great set of criteria for doing that, like quick 5-minute in your head analysis to start. Maybe you could talk a little bit. Are you really that opportunistic in that you'll do a deal that's a 2015 or a 1970s deal? Or can I maybe tell a little bit about, more specifically, if you're looking at a 70s vintage asset outside of Charlotte, and again, doesn't need to be Charlotte specific, but if you're in a older property outside of a big MSA, and so are you saying I'd rather buy that at $80K a door than buying the equivalent $120,000 per unit asset in Charlotte? Or, where do you focus? Do you have that kind of thing, or is it all relative value?
Sure. You touched on 2 hot buttons in there for me. One was, again, vintage. You were talking about, and I'm a sucker for a basis buy. And I'm a sucker for value. So it's not, I've had a bit of flight to quality over recent months and last, I guess, couple of years. And that's not only a flight to quality in asset, but also in economic tenant profile. And I say it that way because I don't want it to be confused with whether that be race or age or anything like that. It's the economic profile of a tenant base, meaning when in the month the rents are coming in. So if you have a property that you're collecting all your rents from the 1st through the 10th, you're going to have a pretty good go of it. And if you're chasing rents from the 10th through the 25th, those are really, really difficult properties to run, and they cause a lot of heartburn and stress. And so we've shifted on what we've been buying in the past. And a lot of times, some of the harder economic properties are also the older properties. But those are just some variables we like to take a look at to try to come up with a quick look at whether we're going to take any kind of deeper dive or not. Sure.
To that point, where do you see that cutoff? Because you talked about more of I guess maybe a minimum income, or maybe it's an affordability percentage of income to rents. Is there somewhere where you're saying, hey, I don't want to see rents more than 25% of income, and I want to see income over 60K in the area, or what's that cutoff at this point for that flight to quality perspective that you're looking at?
I would say it's less. In that, I don't really look at it through those set of glasses. I really look at it for the performance of the collections over the past 12 months, let's say, and previous. And when it comes to the asset, I want a little bit newer vintage asset as well, because like I said, the repairs and maintenance on a 1970s or 80s property is a whole different thing compared to like a 2000 vintage property. So those are the reasons. we've just shifted a little bit.
Yeah, and when you say shifted a little bit, are you so you wouldn't totally say no to a 70s deal if it was the right basis. If you're able to pick it up for the right price, you do that deal, but it needs to be really tasty.
My MO is I fix problems for a living in the multifamily space. I have a set of problems I'd prefer to fix over other issues. And one of my least favorite issues is collection issues. I'm properties that do collect, but they're just getting paid late all the time. That's a lot of heartburn. I'd rather just be vacant and I could start over myself. So I don't mind, a lot of vacancy. And sometimes, often cases, I prefer it. But I do mind culture of late payers that you're chasing them constantly. That's really what I'm trying to avoid. And when we talk about economic profile, and then of course the asset itself, we're trying to have a little bit of flight to quality as well.
Yeah. So and you're looking at the AR reports, you're looking at the bad debt, you're just looking around the property, seeing who's employed, who's not, who's around during the day, the cars, all that type of stuff when you're making that assessment once you get further along in the deal.
Yeah, I would say yes. Yes to all of that. We want to take a look at a little bit of everything. When you're looking at a property and you're trying to decide whether you're going to make a move or not, it's an open book test. All the information that you ever are going to need is available to you. We live in the information age. I'm still a dinosaur, doing things on the back of a napkin with pen and paper, but I certainly use the internet as a tool for information, and it's all there. So it's an open book test. All you have to do is open the book and find the answers. And then you have to decide what information you're going to put the most weight on. And we all have a different maybe paradigm shift in what is going to be primary in terms of whether you're going to make an investment decision or not. And most people, it's the actual income in place. But for me, that's not always the case.
Sure. And you're usually, like you said, you're a problem solver. That's what we do in real estate. And you're, that's no exception for you to over your career. And you said in that last statement, you're looking for certain types of problems you like to solve, certain types of problems you don't like to solve. You talked about collections being a problem you don't like to necessarily have to solve because of the behavior changes and all of that, and just the stress of having to match your revenue and your expenses. Maybe could you speak a little bit about the problems you do like to solve when you're looking for an opportunity that says, oh, wow, this has got this problem and this problem. It's this type of property, this type of tenant. Let's if we can get this at the right price, this is a deal for us. Well,
the best case scenario is you buy a property that's full and they're collecting on time and the rents are just low. So that's a pretty easy fix. But when it's any like physical components are easy, whether if it's roofing or windows or, anything exteriors, it's very easy to fix because you don't disrupt your tenant base at all. And usually your collections. But when you have to renovate all, if you buy a 100-unit complex and you have to go in and put 100 new kitchens, that's pretty disruptive to your cash flow. So my favorite set of issues are everything exterior, where I don't disrupt cash flow. But oftentimes we do have to go in and do full unit turns, and we'll if the yield is right, we'll take on whatever the challenges are. And for me, that starts with basis.
Right. Okay. Well, maybe let's bring it to if you could maybe a recent deals, just something we can stick our teeth into. You don't have to get super specific about it if there's sensitive information. But love to maybe just hear a recent transaction kind of that you really like that kind of hits your current criteria and your view on the market.
I can lay out two that were semi-involved. We had one in Cornelia, Georgia, and I think it was about 80 or so units, something like 80, 82 or 88. I don't quite remember. It was recent. It was this year. And the property was running about 70% physical occupancy and maybe a little bit lower economic occupancy, which just means collections were not 100% on the 70% of the people there. So we had to come in and get that property turned physically so that we could start leasing to the quality tenants that we wanted to bring in. So the very first thing we did was we attacked all the exteriors and made the property look like a Class A property on the exterior while simultaneously doing the community rooms. We tend to over-improve our community rooms greatly and high-end furnishings and things like that. So once we tackled that portion, then we immediately started focusing on doing unit turns to a better quality than what the tenants were otherwise used to. And we did a number of the unit turns. And during the process, actually, we're able to go pending sale with certain breakpoints that we had to perform on, like proving out a model. So for example, in-place rents might have been 800 on these units that weren't great. And maybe we were able to rent for 1,000 or 1,050 on 10 or 20% of the community, and proved out that model long enough to where a buyer felt good about coming in and paying us a cap rate that they would be able to achieve just by finishing what we had already started. So that's kind of a simple property that we've recently done. And then there's another one that was a old school, which we're just in lease up now. We're almost finished. And this was really a property that was all but boarded up. It's a 66 unit property. It had maybe 25 tenants in it when we took over, and it was an affordable property, income restricted. So basically it was, largely vacant, and it wasn't doing anybody any good having all these affordable restricted units vacant. So we made an agreement with the state to allow us to go 60% of the units at market rate and maintain 40% of the units in the affordable program, so long as we renovated all 100 of the units at the same level. And we did that. We did it very quickly, and spent a few $1 million turning that building around. And now we've been leasing for a couple months, and we're about 70% occupied and quickly climbing.
It sounds like you a little undersold. You're really looking for those deep value adds. You're looking for unstable properties with lower occupancy, where you can buy at a great price, and the prior sponsor has just not done a great job at all. Are those typical deals, or is that just what you're seeing in today's market that makes sense?
They are typical, but I would also say it just as typical as a property we buy at 90% occupancy that just has some management tweaks. So, we run the gamut on what we're going to take on. And as long as there's an opportunity in a lane, I'll buy a 2 cap or a 4 cap or a 5 cap, but I will not buy a stabilized 6 cap that really isn't going to go anywhere besides being a coupon clipper. Having said that, I'll turn a 2 cap into an 8 and sell it for a 6. And that's just kind of our MO.
Right. So it's more about that unlevered yield on cost. It's the potential. It's where you can bring the property, where you can maximize that NOI. And so, uncovering those opportunities. I think that the ability to do what you just described, go from a deep value add to a stabilized property and back again, and then execute on all these different types of strategies, especially with smaller assets that are sub 100 units and then larger assets, I think probably speaks a lot to your management style. Can you maybe speak a little bit? You're self-managing these properties. Is that correct?
We are. And it's we get a lot of people that say, oh yeah, we can't self-manage. It's only 40 units or 50 units or 60 units. And I just find that not to be true. We self-manage all over the country, even in markets where all we have is a 60 unit property. So I mean, you have to have a manager in place. That's true. But you would have to we manage our managers instead of managing a management company. The minute you think you don't have to manage your management company, you're going to be in a little bit of trouble at whatever your level is in this business.
Sure. Yeah. Let's dive into that, because I think, the real money, certainly buying, people say you make money on the buy. And I think there's some truth to that in some respects, but at the same time, a lot of the work and a lot of the effort and a lot of the performance improvement comes from really great operations and really great management of that team. So could you maybe speak to, maybe your philosophy or just a little bit about how you think about managing your property management teams and to make sure that they're hitting the performance standards that you expect and the business plans that you look to execute on?
Yeah, sure. I try to keep it really, really simple. I think our whole business qualifications to be a good owner operator is a 5th grade education or equivalent in life experience. So my operational MO, and I call it the 4 C's or 5 C's, and I really like to put it as 2 + 2 = 5.
So yeah, maybe you could talk a little bit about what you're doing today. Tell me kind of, are you looking for new deals? Kind of tell me what you're focused on today, acquisitions wise.
We're very active, and I actually like the current set of market conditions we're in right now, because when the market was going straight up, it was very, very difficult to buy anything. And I feel like the way the market is now, you can both buy and or sell. So I try to stay positive all the time. It's not easy to do sometimes, but in good markets, we make money. In bad markets, we make money. So it's just getting yourself in a position where you don't blow yourself up, and being in a position to be able to act when the opportunity comes. And I think we're kind of in that cycle. I mean, now it doesn't feel quite like 2010 in terms of how bad things got. Well, maybe it's a year or two earlier than that in terms of how bad things got, but it's kind of similar. And people made a lot of money in those times. And I think that now is a good time to act. I don't know what next year brings or the year after, but I think with the right mind frame, you can make money in all markets. And I just think that it's really how you see the world. Again, I said it earlier, I'll say it again now, whether you think you can or think you can't, either way, you're right. But I think it's a great time to be active, and we're going to remain so. I'm actually trying to buy more portfolios so I can get more traction than just buying one deal at a time. But we probably have about 30 pending purchases right now, and we're looking to continue to expand on that.
Yeah, and you're finding that those opportunities are in that 20 to 80 unit space mostly, or do you see it happening in any specific parts?
I really don't want to buy any 20 units anywhere. I kind of try to cut the limit at 40, but I think that 40 to 125, you really get a little bit less competition, because when you start getting 150 and above, you have to start competing against institutional money, and that gets tough because they'll take a low yield. But I just think times are good now. I don't see it the way most do. Of course, I never made a living based on what rates are doing. It might enhance our return, but we typically look at it, as you put earlier, unlevered. So it's just a little bit of a paradigm shift in how you see things, and you could be off to the races and doing, deals again. But if you're sitting on the sidelines because you don't like where rates are, that's unfortunate.
Yeah. One more on this topic would just be, the opportunities that you're seeing on the buy side. Is it at the, I wouldn't want to say at the expense of the prior owner, but are you finding that they're in some sort of special situation where their debt's coming due? Yeah,
it's the reality of the situation. Yeah, I mean, there are a lot of people that bought over the past 24, 36 months and have lost the majority of their equity. So as unfortunate as that may be, gone is gone. And I don't wish that on anybody, but if there's a deal to be bought and we can buy right because somebody didn't do their job properly, we're going to take advantage of it. And in the end, it's the tenant that we're serving. So when I say people didn't do their job properly, hopefully that was not at the expense of the tenant. Hopefully that was just they missed some things in underwriting or whatever may have happened. But we owe our tenants clean, quiet, and safe. And I don't ever want to fail on that. It does happen, but if that's the set of circumstances, we quickly try to come in and correct it. But also just other economic issues we take advantage of when they present themselves.
Yeah. I got to ask one more question. I can't help myself when you say more stuff, but it seemed like you do some deals, right, where you're getting in and then you're getting out quickly, some where you're holding longer term. Do you have a general philosophy of hey, I want to be in and out relatively quick? Is it deal specific, or are you a long-term holder?
I have a very much philosophy that I focus on, and it's I want to do right by the deal, and that could mean anything. That could mean a long-term hold. That could mean a quick turn. If I just held everything I ever bought, I'd be worth 3 times what I am now. But at the time, I have limitations. I don't raise money, so there's only so much we can do. So while that may be a truth, another truth is you never go broke taking a profit. But by doing right by the deal, I feel like it serves me best. When I say by the deal, is doing right by the asset. It serves the tenant. It serves the next investor. If I always do right by that asset, ultimately it's going to do right by me. And I guess what I really mean by that is spending money on it. Whereas sometimes people are reluctant to keep spending. We want to keep making the asset look its very best at all times. And ultimately that serves us while simultaneously benefiting the tenant.
Okay, great. Well, thank you so much. Well, then thank you for joining us this week at Deal Flow. We're looking forward to seeing you next week for another episode with me, Michael Pulio, and more experts in the real estate industry. Signing off for now.